Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Keki Mistry, Vice Chairman and CEO at HDFC, joining in. Welcome to the show, Keki, and always a pleasure to speak to you and get insights from you. Keki, overall, if you go to see last 18 to 24 months have been really, a downtake. Suddenly, we've seen an uphill as well. What's the outlook that you have on the banking system as a whole, especially when you talk from a credit growth perspective?
All right, so when you look at credit growth, let's talk of banking separately for a minute and then talk
Sure.
about credit growth. When you talk of credit growth, you really need to break it down into individuals and corporates. Individual credit growth has been fairly strong, continues to be reasonably strong, and continues to be reasonably strong. As far as corporate credit offtake is concerned, it's been slow for some time now, probably the aftermath of COVID. But give it a little time. My sense is that you will see a pickup even in corporate credit growth in the months and quarters to come. When we talk to companies, some of the companies do tell us that they have a fair amount of expansion plans. They've not yet sort of put that into practice, but not yet put that into actual work, but they will at some point in time. So you will see a pickup even in corporate credit in the times ahead. So that's as far as credit growth is concerned. As far as the strength of the banking system is concerned, here I must compliment RBI for what they've done. 5 or 6 years ago, if you go back, the banking system in India had its own challenges, not just in the sense of non-performing loans, but also the feeling that people had that there was no transparency and there was no proper disclosure of the level of non-performing loans and the stress in the banking system. And I think steadily over the last 6 years or so, there has been a massive cleaning up of the system, cleaning up in the sense that banks have been providing large amounts of money. And this all happened in that 2018-19 period.
Correct.
We saw huge amounts of provisioning being carried out by banks, even resulting in some of the banks reporting losses, not just for one, but for more than one quarter. So today, the provisioning that banks have done is very, very strong. And to my mind, that gives the banking system in India a tremendous amount of strength and also gives investors the confidence that the banking system is very robust.
Right. So overall, with that as well, what's the view that you have on the asset quality front? Because, initially the anticipation was that, there could be major deterioration that will come through, but that's not happened. And it seems that banks have been resilient as well. Do you think that's something where banks actually were well prepared finally to meet such challenges?
So non-performing loan number would have gone up a little bit post-COVID. That had to happen. There is no way it could not have happened. But I don't see anything to worry about in that, because if there are non-performing loans today, they are very, very adequately provided for in the banking system. At the end of the day, what you need to look at is not just the gross non-performing loan, but the net non-performing loan. Because if there are capital of the bank, the capital adequacy of the bank. So these have been well provided for. And the system has been resilient, as you mentioned. The level of the increase in non-performing loans has certainly not been as high or of as high a magnitude as people had feared when COVID had hit April 2020.
Absolutely. And with this, on the RBI policy, the rates have been unchanged. The stance has continued to remain the same. Do you think this was in anticipation that what if a third wave of COVID in terms of Omicron hit us? Or do you think this is pretty much in line with what everyone's expecting?
It was in line with what was expected in the sense that I don't think many people would have expected a rate increase in the RBI policy. I think RBI was very cognizant of the fact that the system, the economy has been recovering at a very brisk pace, and they didn't want to derail that growth. Also, interest rates are a function also of inflation. So as long as RBI believes that inflation is transient in nature and is not sticky and is not long lasting, there is no need for anyone to increase interest rates. And by keeping interest rates low, if that is helping economic growth and helping all sections of the economy. So what RBI did, and again, I must compliment RBI for their role during COVID-19. In April, May of 2020, they injected liquidity in the system. They continuously kept doing that. Not only did they inject liquidity, but also compliments to the government. They came out with so many schemes, so many products, which ensured that the liquidity just doesn't reach a few people, but reaches every segment of the market. And that is the reason why we did not see any serious stress in any financial institution or any bank during this COVID period.
Right, absolutely. And RBI has been really proactive instead of being reactive, which has been a positive factor for us as well.
Or let me add one more thing, that what RBI did also, apart from the various other measures, is they kept infusing liquidity.
Correct.
And as they kept infusing liquidity, short-term rates came down very sharply.
Mm-hmm.
Now, my personal view is that forget the third wave of COVID. We don't know whether there'll be a third wave. If there is, what will happen? Let's forget that. Let's for a moment assume that is not on the table. Then my personal view is that RBI will start sucking out some of that liquidity gradually over a period of time, which would mean that long-term rates remain where they are, but short-term rates will move up a little bit. So today we have a pretty steep yield curve because short-term rates have come down, long-term rates were where they were. As you pull out some of that liquidity, short-term rates will start going higher, long-term rates will remain where they are, and the yield curve, which is steep at the moment, will start flattening.
Correct. Right. So with this, if you have to talk and maneuver towards home loans are concerned, what's the roadmap looking forward? Because in terms of demand, probably again, the anticipation was that will there be enough liquidity in the system for people to go purchase houses? And that has given us a phenomenal number, at least in that period between October to now, and a good amount of sales that we've seen, which probably is record breaking. Are you expecting this kind of trend to continue? What's your view?
All right. My view is the trend will continue, but let me explain this in a little more detail. So if you see the last 4 years, let's forget the last 12 months. Leave that. But if you look at the period from 2017, I would say mid 2017 till probably the time COVID set in, we saw demand coming largely from the outskirts of big cities and from tier 2 and tier 3 towns. The demand from the metros, the big cities, the heart of the big cities, was relatively muted. What we've seen now over the last 12 months, or maybe even a little more than that, 15 months or so, is that the demand has started coming even from the metros. So today there is all-round demand in the system. Earlier it was in the tier 2, tier 3 towns and the outskirts of big cities. Now that momentum continues, but there is increased momentum even in the heart of big cities. I would attribute this to 3-4 reasons. One is the fact that if you look at the last 3.5, 4 years, property prices in the metros really haven't increased much. In fact, haven't increased. Most projects have not increased, but income levels have consistently kept rising.
Correct.
So if you assume that incomes rise at about 8% a year over a 4-year time frame, you're looking at a more than 35% compounded growth in income over that period of time. So incomes being a lot higher, property prices being where they were 4 years ago, clearly affordability has improved. That's one reason. Second is the feel-good factor, which is there in the economy. As a result of the measures taken by the government, the measures taken by RBI, and the resilience of the Indian economy, we have seen that economic activity in India is back to normal. We see this on a day-to-day basis as we move around on our day-to-day lives. And as economic activity keeps getting better and better, people start feeling more confident about their future. So the feel-good factor is very strong. And that feel-good factor is also contributing to the demand. And the third was also low interest rates. Also, the fourth factor I would say is that the perception or the belief, or I would say perhaps a wrong belief, that there was a huge amount of oversupply in some of these metro markets, particularly if you look at Mumbai, that has proved to be wrong. Because what COVID has done is it has made it more imperative for most people to look for bigger and larger homes. And as they look for bigger and larger homes, we've seen that pickup in demand in metros. And with that pickup in demand in metros, people have suddenly realized that there is not that much of excess supply in the market to start with. And therefore, the feeling that prices in property prices can never rise, that feeling has gone away. So if supply is not that as high as it was perceived and demand continues to remain strong, then you run the risk of prices going higher unless you take a decision to buy a house now. So that's also contributing to the demand.
Right. So overall, the roadmap looks really strong over there. Moving from there, in terms of where the economy goes, Keki, overall, again, the impetus has been how growth will be. However, the RBI has not really left the focus on inflation. There's a pretty much like a hawkeye in terms of how inflation pans out. And it's not only in India, across inflation is a concern as well. So how do you see growth versus inflation?
I mean, to my mind, the best people who would be able to judge how serious the inflation is or how sticky the inflation is would be RBI. And RBI seems pretty convinced, and I would certainly go by that inflation is transient in nature. It is not sticky in nature. It is created by factors which are either temporary in nature or factors will get resolved. So I would not worry too much about inflation at this point of time. Oil worries me because India is a large importer of oil. And with oil prices at wherever $73, $74 a barrel, that does put some sort of a strain. But look at the fact that our foreign exchange reserves have never been as high as they are now. We are, I think, now the 5th largest country in terms of carrying foreign reserves. So we have the foreign exchange reserves to be able to withstand higher oil prices. So I don't think the market is unduly worried about inflation in India, at least in the short term. In the medium to long term, we'll have to wait and see. Also, hopefully, the monsoon outlook for this year's the monsoons have been good. A good monsoon means reasonably good food produce. If the food produce is good, then food inflation would not be there. So those are some of the considerations RBI would have had.
Right. And overall, in terms of spending, how important is it, according to you, for government and private spending to pick up from here on?
We've seen a lot of government spending. Private spending, if it picks up, will obviously help a lot. As I said earlier, that credit offtake in the banking system, particularly from the corporate sector, has been relatively slow. And that, if it picks up, that the momentum of corporate credit offtake together with government spending money on various kind of infrastructure projects and so on and so forth, will create even more job opportunities, even more employment opportunities, which in the long term will be very good for the Indian economy. And I do believe that credit offtake will pick up in the months, quarters ahead. All this I'm saying on the assumption that there is no major third
Correct. Absolutely. I think now in recent times, even assumptions is a very short period of time in terms of outlook because you don't know what unfolds. So my last question coming to you is, if God forbid, Keki, if there is a third wave with regards to COVID, I mean, again, everyone's expecting that it will not be as bad as what we've already seen in the first and the second wave. Do you see any major impact on the economy and the sector, or do you think we've become resilient enough to probably surpass that?
Right. So I don't see any major impact on the economy arising out of a third wave. We saw the second wave, which was, as you know, quite devastating from a health perspective. But we saw that the effect it had on the economy was very, very short-lived. We did see a slowdown in the months of April and May, but once things normalized in early June, everything bounced back. And today you can see the level of economic activity in every sector of the economy. So I don't expect or believe that the third wave would be one serious, according to at least whatever we read in the newspapers. More importantly, its impact on the economy, to my mind, would be very limited.
Absolutely. Hoping for the same as well. Thank you, Keki, so much for joining us on the show. Stay safe and speak to you soon again. Thank you.
Stay safe. Thank you so much. Bye-bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.